Hi, this is Proact Sam. For any of you that are still here, welcome. I'm so sorry about our delayed start to the live webinar this morning. We had a bit of a login issue, whether it was a cyber attack. I better not mention Russia today. But we were connected up and thought everything was going to be okay, but it sort of backfired for us. So today's live webinar is about how to avoid inheritance tax on your for your family on your overseas property, business, and expenses. So we're looking at this from inheritance tax. I'll talk a lot about the UK, but obviously inheritance tax is payable in many countries, and in some countries it's not. We as tax residents, as expat tax residents, what we can look at is how we can alter the game. What your personal assets are. Oh my God. I've just had another freeze on the internet. What your personal assets are assessed on your death for inheritance tax. So during your lifetime, you've got capital gains liability on your property, business, and investments that you can dispose of. Now, how can you avoid tax on that? We've discussed that in other live webinars, but we'll cover that briefly here. But on your death, that you definitely avoid capital gains tax because inheritance tax becomes available, and inheritance tax is charged at 40%. Subject to what relief and gains that you need. Now, we've covered in previous webinars that 40% inheritance tax is payable, not between spouses. So if you, it's not charged on first death, it's only charged on second death. So that's the first thing to mind. But if you don't plan while you're both still alive, your spouse, your civil partner, if you don't plan while you're still alive, then you're going to pass all the liability onto second death. So just have that in mind, that if you don't need to take action on first death, but then you leave everything to the partner on second death. If you're single, you're not in a marital relationship, inheritance tax is applied on first death, even if you've lived in the same property with the same company and the same investments for 40 years. So it is something to plan ahead because there is no hope. You are going to die. So you can make a plan while you're living, or you can wait and make a plan when you die. So for our retained clients, we're running this live webinar on Facebook in the retained client group as well. And once the webinar is finished, we will cover more detail in a question and answer session. You can avoid capital gains tax between spouses, so that you can gift between spouses. There's no capital gains tax. Effectively, between spouses, the capital gains tax is just transferred. There's an annual allowance you can gift, so you can give away 12,000 of crypto investment, business shares a year without all property. Realize that gain and give that away each year. And the only other way to avoid capital gains tax during your lifetime is by giving it to charity. So you could do that as well, and that might not be a bad thing. For inheritance tax, these gifts to avoid capital gains tax can also avoid your inheritance tax, partly because obviously they're not in your name anymore. So inheritance tax can apply during your lifetime, but generally it's capital gains. So when does a lifetime inheritance tax apply? Inheritance tax applies when you make a substantial gift outside of a relationship. So you can give it a small amount to your children, up to 5,000 on marriage, for example. There's an annual exemption of 3,000 a year, which you could give away to children or what have you, to be exempt from inheritance tax. But when you give away larger sums, a lifetime inheritance tax gift applies. So if you gave away 100,000 in the UK, 20% inheritance tax is applicable if it's a gift that's exempt from capital gains tax because it's an inheritance tax gift. So higher rate capital gains tax on investment, crypto, and business is 20%. So in effect, lifetime inheritance tax is capital gains tax. So you just have that in mind. Those are, in essence, are the gifts. So there's an unlimited, with inheritance tax, an unlimited gift that you can give to your spouse, but also there's a limited gift that you can give to your children in your lifetime. And what we're looking to do all the time is make sure that during your lifetime with your spouse, civil partner, that you're planning ahead so that your family benefits are not the tax man, and that you're not leaving everything onto second death. Now, I said I wouldn't mention the Russians, but a quick incident here. Those of you in the current know, you'd see features about Chelsea ownership, football club ownership in the news. You know, it's owned by a charitable trust. So trusts are a way of owning assets and passing them without the need for probate and with different type of tax rules. So that's a way that you can manage your affairs to keep control of the assets during your lifetime, and plan for the tax. Now, when you've got assets in a trust, there may or may not be tax that's payable on those, but there's no probate. So the cost and delay of probate is removed for your spouse, your widow, and your children. So that's a benefit of using an arrangement. A company shares, a property, or investments can all be owned within a trust, avoiding the need for probate and the cost of delay of that. If you put money into a trust, then potentially there's a capital gains, but also if it's treated in inheritance tax, you can give a potentially exempt gain. So a husband and a wife can both give $325,000 without any lifetime inheritance tax as a potential exempt gift. Now, if they die next day and that money is left to their children or their beneficiaries, then inheritance tax is part of the assessment. That 325 is part of your allowance on death. But with a potential exempt gift, if you're planning ahead and you survive more than 7 years, there is no inheritance tax. So every 7 years, a couple can give away 650,000, or a couple or single person can give away 325,000. Now, you might not want to lose absolute control of that, but the way to do that is to use a trust to own the ultimate assets, and that way you've got an arrangement where the ownership, the custodianship of the property, investment, or business is controlled under the terms of a trust by the family, but your gift can be potentially exempt from inheritance tax later down the line. So that's something to bear in mind. So potentially exempt gifts are not a deathbed option for avoiding inheritance tax. That is the Ken Dodd approach, where you get married and give everything to your wife on your deathbed to avoid capital gains tax, inheritance tax. But the problem doesn't go away. But with long-term planning, as you've accumulated investment, property, and crypto and business wealth, gifting that over a long period of time can mean that potentially over every 7 years, a family can give away 650,000. So over 20 years, you can give away nearly 2 million of assets free of inheritance tax, all as a potentially exempt gift. If you're gifting the shares of a company and then that company builds up in value, if Chelsea Football Club builds up in value and it's within a trust, then that tax liability, that additional inheritance tax or capital gains liability, builds up in the trust. It's not your personal liability. So it's not just that you're moving the shares of your company into a trust now, it's that in the long run, the wealth that you generate during your lifetime on the investments and property and crypto and business accumulate as a liability of somebody else, not your personal liability. So we saw a few weeks last month where the Matalan empire tried to avoid a capital gains tax with a gifting strategy and going expat. Didn't work. Watch again our webinars on that. So there is a way to do that if you plan ahead. If you go expat, that gives you extra benefits and extra options to do that. Now, in the UK, a trust has tax on income and arising. And anything I say in the next 5 minutes about Cyprus trusts, Cyprus international trusts, if you've got an asset that's owned in a trust, whether it's Chelsea Football Club or whether it's your overseas property or your business that you're trading from cross-border, or it's your investments or it's your crypto, you're not going to avoid the tax at source. So if you've got a trading company in the UK and you've got a corporation tax liability, then that tax liability will still be due. If you've got a property in the UK and you sell it and dispose of it, that capital gains liability or the income tax liability is still fixed in the UK, so therefore it's taxable in the UK. So we're not talking about getting rid of the current liability. We're talking about protecting from the potential end game capital gains as the accumulated inheritance tax on death. So in that respect, a Cyprus International Trust is free of any Cyprus taxes at all. It doesn't have any income tax, doesn't have any corporation tax, any tax on dividends, any tax on interest received. So it can be a fully functioning part of your overseas business as an expat. It's got a separate tax resident in Cyprus, and it can distribute benefits to you. Anything it distributes to you is potentially a liability where you are, but you can enjoy the asset, the property, or the business. You can work in the business to get the income. You can have a situation with a trust where the capital is in trust and the income is not. So, and you can have quite tight rules with the family trust that we write at ProAct to ensure that it survives you across border and down generations. So on first or second death, everything's still going to be in place. Especially important if you've got second and third marriages, that can protect you against that as well. So that there's no capital gains, there's no inheritance tax, there's no Cyprus taxes at all. And it's not just that there's no Cyprus taxes, it's that the tax on the Cyprus trust is zero. So if you can use a gifting strategy with UK or overseas assets and accumulate your wealth, whether that be from investments or property or business, over the years inside the Cyprus International Trust, then you're having something where you avoid probate, you're avoiding capital gains tax on the accumulated wealth of the asset and disposal. Your family has got complete control of the assets, and there's no inheritance tax to pay on death. So it can work as a long-term strategy. For more information on how to organise and plan your family's business, property and investment and crypto assets for expat, using a tax residency which is separate to you as an individual, so accumulating wealth in a separate tax-free location, you can contact us at proactpartnership.com. And with that, I'm so sorry about the staggered start with the internet hiccups. I'm not at all sure what that was. I've had it for the last month, week or so. Anybody that's been involved with me helping them with end of year tax returns knows that. So watch again next time with the new series of webinars where we're looking at the new tax year going into spring for the calendar year tax expats in Cyprus, Portugal, and Spain, and for the new UK tax year, which starts at the quarter day at the end of March. So we look at what's new in tax and what the implications are that are going to be for the year ahead for expats living and working abroad. I hope you've enjoyed this webinar. If you are a retained client, you can jump over, potentially get onto our private client group where we'll do a question and answer session next. Thanks for listening. We'll see you again next time. If you need to book an appointment, go to privatepartnership.co.uk. I've got a question from a client. Oh, God. I've just got a couple of questions and I'm doing the answers now. I should say them, not type them. I was going to end it, but how do expats set up a property structure in order to invest in UK property from an offshore company? There's obviously cross-border money laundering checks are quite intense, so we need to bear that in mind. But it is possible. And again, using the Cyprus Trust could be the medium of a new EU-based zero tax regime, so neutral in terms of giving you the portfolio to then invest overseas. There's no inheritance tax between husband and wife, so you can gift to husband and wife without there being any liability, or civil partner, or charity. But that defers the issue. So if there's a short-term health issue, you gift the property or the asset straight away before death to a spouse. That would avoid inheritance tax, but there's still a tax planning liability later on. By husband and wife can potentially gift 325,000 a year into a trust that would potentially leave the whole thing exempt, indefinitely after 7 years abroad. So if you create a new company with a nominal value of £1,000, and those shares are put into the trust, that is the gift to the trust, and obviously that is below the UK inheritance tax limit, so it could be your annual gift. The accumulation and profit and the investment or the borrowing or the assets that are built up from that becomes a whole different ballgame. So it actually opens up quite well going forward. So we're talking about long-term planning, not short-term alleviating issues. So any gift to inheritance tax over 7 years avoids inheritance tax. So I definitely am ending the YouTube stream here. Thanks for those questions online for the YouTube. Sorry I didn't see them earlier. Jump to the Facebook for any more questions and answers. Thank you. Bye.